Thank you so much, Rosemary. My name is Anna Acton, and I'm the chair of the California Foundation for Independent Living Centers, or as we refer to as CFILC. CFILC's mission is to increase access and equal opportunity for people with disabilities by building the capacity of independent living centers. So I'd like to thank all of you for coming to this webinar, and I'd like to introduce Paul Calabrese. Hopefully I'm saying your name right, Paul, who's the Senior Manager for Rubino Company. Paul provides accounting and consulting services to nonprofit and government contracting clients. He has over 30 years of professional experience and is a dynamic trainer with expertise in federal grant awards and related indirect cost rate development and the associated agency submissions under OMB Circular A-122. Paul has experience with grant awards per OMB Circular A-110 and certain agency-specific requirements such as health and human services. So Paul, I've had the opportunity to work with Paul. I'm the Executive Director at Freed Center for Independent Living, and we are going through the process of developing our indirect cost rate per the new requirements. And so I've had the opportunity to work with Paul, and we thought this would be a good opportunity to bring Paul onto the webinar platform through CFILC to provide some training and technical assistance for all of us who are going through this process, whether you've already developed your indirect cost rate or you're in the process of doing that, or how you're going to implement it. I know this is a major change for many organizations that may have used a different system for determining costs. So with that, I would like to pass it over to Paul, and thank you, Paul, for joining us.
Hello, everybody. Like Anna said, I'm with a public accounting firm, Rubino Company. We're in Bethesda, Maryland, Washington, D.C. area, and I'm in the consulting group. And so I a little bit feel your pain. I know this is a challenge to move from a cost allocation plan to an indirect rate. And we've worked with Anna, and we see that it's not such a straightforward process all the time. What we're doing today is we have a two-part presentation. The first part is really what is the uniform guidance. As you know, the OMB Circulars disappeared. And so what does the uniform guidance have to say about indirect rates? And we'll kind of keep it short and sweet to an hour. We'll have an hour break, and then we'll come back and we'll talk about building an indirect rate together. And that's really the approach today, and so I hope that this is helpful. You're welcome to contact me. I love to talk about rates. I know for you it's not your thing probably, but it is my thing, and so I don't mind answering questions if you aren't able to fully have them answered through this process today. I'm still around. You can see my contact information, but if you do contact me, do it through email because I'm often out of the office and you might leave a voicemail and it may be a day or two. But I'm happy to answer questions in any way to be a resource for you in this manner. We're going to be talking about the administrative requirements and the cost principles from the uniform guidance. It's interesting because there's two sets. It's the same regulation, but you know HHS, they like to do things differently. And we love HHS, but they do it differently. So most uniform guidance is under a Regulation 2 CFR 200. They're under 45 CFR 75. And they supersede 74 and 92. They no longer exist. So their uniform guidance is under 75 dot whatever. So you're seeing basically, even if I have 200 dot something, you would just insert 75 if you're into regulations, which most people aren't. There's something else that I would like to share with you. As they go along, the writers of the uniform guidance did a wonderful job in trying to provide to all of us in this world FAQs. And so I inserted those FAQs, and they've updated it 4 times. In September 9th, 2015 was the last FAQ. And it may surprise you what they have to say about the regs that they wrote. So we'll have some of that interjected as well. So we're going to talk about the uniform guidance, the impact on the rates, what's new, and then the standard negotiation and administration of rates, which really has not changed. And we're really going to talk about two main methods, simplified and direct allocation methods. There's a couple of more, but they're a little bit more sophisticated, and we're just going to stay away from them for purposes of making this straightforward. So in the uniform guidance world, there's a structure that they have. It's a one-stop shop. If you remember the old OMBs, there was an A122 and an A87, and all of them, there actually were 8 of them, and they were pulled into one fun little book, big book, and they call it the Uniform Guidance. And for nonprofits, their allocation methods are found under Appendix 4. So we're looking at Subpart E of the cost principles, which deal with the Uniform Guidance. Okay, so the first question is, and there's a lot of words on a lot of slides, and the reason why my style is to leave you stuff so that if you walk away from today and say, what did Paul say, you at least have some reference as to what I talked about. But the gist of this slide basically is that your proposals and your indirect rates, or if you're still under a cost allocation plan and updated every year, it doesn't come into effect with the new uniform guidance rules until basically the first fiscal year after 12/26/14, which would be a fiscal year that begins 1/1/2015. For some entities, they may start 7/1/15 and have a year end of 6/30. So then it would be that fiscal year that all of this new rules will come under effect. They also said that, and this may not apply to you guys, but they basically said it's whenever a negotiated rate is due to be negotiated. Sometimes they may give you a 2-year window. And HHS may say, once you provide a new rate, they may say, you know, we don't need to see you for 2 years. So look at your negotiated indirect cost rate agreement, which may start out as a provisional rate for most of you, and see when do they want you back to renew your rate, because they may want to give you some time, you know, to use this new provisional rate in new applications and so forth, and they realize you may not need it right away. If you were under the old rules as an example and you hadn't converted over, then you would be under the old cost principles. And that's probably the gist of this slide here. And the next slide is just simply talking about indirect cost rate proposals. So your proposal, which comes first, and the indirect rates and the cost allocation plans, the new rules don't take effect till 1/1/15, beginning of fiscal years and going forward. What's interesting about these FAQs is, and you may scratch your head a little bit and say, they also say there is no mandatory requirement to have an indirect rate. With you guys, it's different. You're going to have an indirect rate if you want to recover indirect costs under this switchover. But they're just saying there's not a mandatory requirement. Some people, you know, they're 100% direct and so forth. And with you, that because I've worked with Anna's group, there may be a little bit of carefulness in that discussion, in that some groups may have core grants that really kind of cover operational and what you might call administrative costs. So we have to take a deeper dive and try to understand what it is the grants we're doing and so forth. And there probably is some indirect that you need to pull out. But they're just saying sometimes people don't need it because, you know, they're 100% direct, or it's just too much effort and they want to use what we'll talk about in a minute, the de minimis rate for 10%. And they just don't want to go through that whole negotiation process, and we all understand that. This slide, the gist of this slide is basically saying that if you want, say you develop a rate and it's 30%, and you may say, you know, because we have enough other resources, and I know this may be rare, maybe many of you are not in this situation, but because we have so many resources, we need to move more of our costs to the program and less to the indirect piece. Because remember, when you do a grant application, you start with labor, right, fringe, equipment, supplies, travel, contractual, other, and at the bottom is an indirect line item. And that will show up in the future for those of you who get these negotiated indirect cost rates. So because of that, you may say, we need more for a program, less for indirect, and that's what they're saying. They acknowledge that some organizations, as long as you're not forced by somebody to do it, they're just saying to you, you know, hey, you can volunteer and have a less rate than your determined rate, the rate you computed, if you wanted to, as long as you're not forced. And they emphasize that because, you know, it wouldn't be fair. The gist of the next two slides is basically the fact I've dealt with a groups that are what they call the Ryan White HIV/AIDS program, and they have various parts to it. And Ryan White is called the payer of last resort. It's not a fun program because it's into a lot of medical management systems and super duper complicated. And they only give a 10% cap that would apply to administrative costs, and administrative costs can be direct or indirect in their case. And what they're saying is that even in a situation like this slide and the next slide are talking about it, and they're saying, you know what, we wanted to use our 10% admin cost direct, and but we have nothing more that we can recover indirect. But what the government's saying in this slide is, even so, because you have federal money, you're still entitled, if you want to submit, for negotiated indirect cost rate. You might say, why, if you are capped out on your admin costs? And the reason is because you may want to use it for other HHS agencies or other agencies within the federal government. And so that's really the gist of these two slides. What's new with the cost principles? This is the de minimis rate, this wonderful 10% de minimis rate. As some of you are saying, you know, after Paul talks today, I think I want to run for the hills. And I don't blame you. And let me just take one step back. I do realize that some people on this line are not accountants, and there's accountant speak and gobbledygook that accountants have, just like you have in your programs. And so, you know, there is some of that bridging of the gap. I mean, some people will look at accounting like a foreign language. So I understand that. And also accounting, and then there's different areas of accounting like cost accounting, and that's in cost accounting with the federal government, which gives us these indirect rates. And all of it is an art. Yep, it's an art. Even my doctor, when he talks to me, he says, you know, medicine is an art too. Ugh, it gets a little scary. But it even gets scary with these indirect rates. And I understand that. And I can only just present this stuff to you, and whether you're listening and you have that expertise, or you're going to say, here, my finance person, you take it and try to deal with an indirect rate, and you deal with the challenges of it. I understand that. And that's why I'm open to answer questions when people call, as long as it doesn't get into a consulting assignment. I'm happy to answer those questions to you, because I understand it is a challenge, or to the person you consulting you give it to, and they want to be pointed in the right direction. So I understand all. There's a lot of language in this, in the world of indirects and in the world of federal grants management. So going back to the 10% de minimis rate, what they're saying is, we'll give you a fixed rate, and you don't, if you've never had a negotiated rate, and many of you who've been on cost allocation plans, you really never did have a negotiated rate. You had a cost allocation plan, which is something entirely different, I would assume. So you could apply for a 10% de minimis rate, and you'd say, well, how is that computed? It's computed, as you'll find out later, on a fancy term called a modified total direct cost base, the big base. But then from that base, certain things are pulled out. So if you had a lot of subawards, we would have to pull that out, so it's 10% on maybe something less. And we'll talk about that later. But it means you've never had a negotiated indirect rate, and you continue to use it until you want a negotiated rate, and direct and indirect charges must be charged consistently. So they're beginning to say to you, even though you're using a fixed rate, we still want you to set things up in your mind and the way you operate as, do you have an indirect cost and do you have direct costs? Because you still need to do that. Now moving along, let's go into extended rates. Oh, one thing before we go to extended rates. This is a big deal for a lot of you. Some of you are funded by state governments or municipalities. Some of you get or have a combination where you get direct financing from the government, federal funds. And technically, the PTE means pass-through entity. So if the state, like the state of California, is passing money that's federal from the government to you, they have to honor your negotiated indirect rate. And some have been already told, we're not going to pay more than an X amount. So that does happen. And let's face it, we can't change City Hall because the state, especially like California, they're not supposed to do that, but they may do it. I know there are other cities that do this game too. Or they'll just say, well, you don't like it, you don't use our rate, then we'll just give you all state funds, you know, and then you have to honor our rate by the limitation of whatever that cap is. So we do recognize realities of that, which we'll talk later about, maybe keeping your rate low as possible, which we'll talk about later. Now, the passive entity can also negotiate a rate with you, but most of them don't like to do that. And then there's this de minimis rate. And if it is a de minimis rate, it cannot be less than 10%. So you get the full 10% on it. So the other thing that's willing for you to understand, which won't apply to you, but I thought I'd just go through it real quick. If you had a negotiated rate and you had a break of relationship where your rate and your grants expired and you want to start this process again, you still have to have a negotiated rate. They're not going to let you have a de minimis rate because they feel you have the infrastructure, and that's that. If you were just totally a direct organization where you had no indirect costs, and again, I caution you that if you're receiving core funding that kind of supports the operational costs, technically you do have some indirect costs that are being funded that way. It's kind of, you know, loosey-goosey. It's a different kind of thing, and if someone puts a microscope on it, they may not like it, but that's just the reality of what it is. And when you come out of that environment, there is some indirect costs, and you'll have to separate. But they're just saying here that the de minimis rate is generally to cover the indirect piece, and you can make that argument. But I just wanted to present that to you as one of their interpretations. And then if you were with a state and local tribal unit of government, probably shouldn't have included this slide, and your unit's more than 35 million, I mean less than 35 million, you could also have a de minimis rate, but you have to document it. Okay, so now let's go on to the NICRA itself. Say you get a negotiated rate. Once you get that negotiated rate, you can have it extended up to 4 years. And by the time most of you submit, you're already going to be into the uniform guidance world where they've transitioned. But you have to remember, if you want a rate, it will be like a final rate that's not subject to adjustment for up to 1 to 4 years. So it's something to think about. And then they clarified, and they just wanted you to know, let's say we settle a rate in 2015 for 15% with HHS. You could have it extended. That means 15%, whether your rates change or not, for the next 4 years. So you got to really think about that. And my opinion is you should do it every year, but it's up to you. If you have it extended for the next 4 years, you know, you can't have it exchanged. Then in 2020, you come back, redo the rate again, and then you can do it for another up to 4 years if you want. So that's what this thing says. And then people said, is there any special documentation requirements? No. They want to make this as simple as possible. If you do want to extend your rate and you already had a negotiated rate and you don't know up front, they're just saying give the government at least 60 days before it expires to make that decision with you. And then what is the current rate? What is the current negotiated rate? Basically what they're saying is if you had a 12/31 and you're starting with a 1/1 fiscal year, you would have to have final rates for 12/31/14, completed your single audit if applicable, and then submit your 15 rates. And then once you submit your 15 rates, basically you can extend from 16, 17, 18, and 19. But you have to come back in 20 and do another negotiated rate, and then you can extend it if you want. However, if you should have a procurement contract that's cost reimbursable, it doesn't apply to procurement contracts. They're under the Federal Acquisition Regulation. And if that doesn't make sense to you, you don't have to worry because you don't probably have them. If you do have them, you would understand the difference, and it's a different set of rules. Now, they did give the opportunity of administrative staff to charge direct. And again, if you have core funding, that's probably what's been happening. You may have part of your or all of your ED. You may have an accounting person. You may have a center coordinator. You may have all kinds of people that are charging direct. And if their purposes are related to direct, that is perfectly fine. For example, in a small entity, the ED might be the principal investigator or the program manager and doing a lot of technical things because their revenue and their expenses are, just a couple of million or less. And so it's natural to see these people wear many hats, and they have to charge direct. So it's fine if the administrative services pertain to the project, and you can identify the project. How do we identify it? Through time reports. Okay. And the administrative wages, of course, must be included in a budget. Budget is a very important thing. Your application budget is a control thing. And it's very, very important that that you put in a narrative and you explain who's charging direct and why, if they're an administrative person, and why they need to be direct. And so as you go to future years with your application budgets, these are things you may want to consider. But once a person, let's say an ED, does charge like a principal investigator or a program manager directly to an award, that is direct labor. It's no longer indirect labor and would come out of any indirect labor pool. So just be aware of that. I mean, it can only be direct or indirect. It can't be both. Another thing that they developed, which I think is a smart thing, and that is called the direct cost allocation principle, not to be confused with the direct allocation method, which we'll talk later. And basically what it's saying is that, and this, the only way I could relate this is, let's just say, pretend you're training youth for, they're going to go into their senior year, you bring them to a university and get them excited about college, and you have a program, but you have two programs. And effectively they're both doing the same thing, and it's about $100,000 for let's say 100 people, if that works in that world. And so what you're saying is, well, one program had 55 people and another had 45 students, and so you could say the simplest way to do it is, look, I got 55 students, it's all the costs are the same for both. If they weren't, you pull out one or two costs that are unique in one or two areas, and then the costs are the same for both groups. And then I allocate it on 55% and 45%, because 55 and 45, nice even numbers. 55% of 100,000 is 55,000. 45% of 100,000 is 45,000. So it's that simple, and it's just a new kind of allocation principle they want. And many of you who have cost allocation plans probably are doing something like that already, like with occupancy costs or other things. The bottom bullet just simply says, if you purchase something on an award and you purchase that item, you know, sometimes those items last for longer. This is not a consumable, but something that goes on an award, some kind of equipment item, and you were to purchase it, and so the award is only for 1 year. It stays on that award for costing, but of course, through a property trust arrangement with the government, you would tell them at the end of the award, hey, we want to move that to another purpose, but you don't need to move the cost. That's all they wanted to make the point there. Now we start to get into unfun things. These were nice things that the government gives you more flexibility, but the government's been, because I also work with government contractors under a totally different set of rules, and there's some not nice things that they're asking, and they're very concerned about unallowable costs. And the first thing they talk about is unallowable and donated services receive their allocable portion of indirect cost. And costs applicable to a federal award, you can't cost shift them to cover funding deficiencies on another award. Some people have a misunderstanding, and I know this may be a surprise to some people. They think if it's direct, it's billable. And if it's not billable, it's indirect or something else, and that is not the case. You can have unallowable direct costs that are not billable, that are not recoverable, and we're going to go through that shortly. And you should understand there is a difference. So I present that to you. Limitations on allowable costs, you could have a determined rate with HHS of 15%, but maybe there's something in the award that limits you to 13%. Or it may just simply be funding. You know, you had to use more money for a program, and so the line item money that's left under indirect is much, much less. So whatever those limitations may be, whether it be funding, whether it be an artificial cap that was put on in a grant, whatever those caps are, that's what you're limited to, even though you had a higher determined rate. And those kinds of situations happen, and they're trying to bring it to your attention. This is the beginning of the standard that basically says if something is made unallowable and you incurred that unallowable cost, the government has a right to be refunded with that cost plus interest. And you can see some of the reasons as to why. Generally, it's a regulation. And so they now go into, well, what if you had an indirect rate and it was negotiated but it had some unallowable pieces? And basically what they're saying is that amount needs to be removed and adjusted for some kind of refund. And so that's just something for you to consider. It applies to all kinds of full rates. Well, we lost something at the bottom of the slide, but basically it applies to provisional rates, the final rates, to predetermined rates, and to ceiling rates, fixed rates. So that's what's missing at the bottom. Thankfully I remembered. Adjustments to previously negotiated indirect rates. Okay, how do you do it? If it's a projected rate and there's unallowable costs in that rate, you take it out of the numerator. If it's for a historical past period and it's already done, they're going to want that back dollar for dollar, unless, of course, well, I should say, depending upon how your indirect rate, if you have some non-federal work, then it won't be dollar for dollar. but they'll want that amount back on a prorated basis with interest applied. And if it's in the current year, you can use any method to do that, either a refund or basically an adjustment to the rate. And then if it's multiple years, and you had something unallowable in the base year, there'd probably be some way to extrapolate that into the future years. So this slide is very important to understand, because the government's saying, look, we're giving you some flexibility, but we want you to understand that when you do your budgets, your annual and final reports or your vouchers, and especially with vouchers or it's an invoice or it's a draw, whichever way you're doing it, you're making a claim to the United States government. And I know you people are honest, but what they're saying is there's a few dishonest people out there, and they're saying you're kind of certifying that to the best knowledge of your belief, they're accurate expenditures and disbursements. And the bottom line is a very serious statement there. Let me see if it does it. I don't know if it, hold on one second. I don't know. No, it doesn't do it. But this highlighted part at the bottom says, I'm aware that any false, fictitious, fraudulent information, or omission of fact, is covered by something called the False Statements, the False Claims Act. So if the government really felt you did something wrong, they can assess a penalty on every draw or invoice you did up to $11,000. And if you did that over a year, you're way over $100,000. So you really, really want to be careful. And we're not talking about 5 minutes wrong on a timesheet or something. We're talking about serious stuff where you didn't have the support for the costs. And the government would have to make a big to-do about it, but if it did, they're just showing you what could happen. The last thing has not changed, but you had cost allocation plans. And some of them may have not even been updated every year. But for indirect rates, you have to certify CFO, VP, or some executive officer, basically that the costs in there are not unallowable and they're not inallocable, that they're allocated properly. If you didn't do it and provide that certification, the government could develop its own rate if it wanted to, or deny you a rate. Or if they develop a rate, they have to make sure there's no unallowables in it. And that's the gist of that one. So now we're out of basically the stuff that's new. Now we're just going into the regular stuff. And the first thing I'm amazed the government does, which is correct, is that they're never standardizing anything. When someone says to you, the government's going to standardize our rates, and the answer is no, they're not going to standardize rates, because they know everybody's system is different, the kind of funding, the way it works, and I know independent living centers may have, many of them may have core grants to help the infrastructure and so forth, and that's fine. So everybody's structured a little bit differently, and the government understands that. So when people say everything is going to be standardized, well, they may make you move to an indirect rate. Even the way you move to it may be different, entity, organization by organization by organization, and they recognize that. However, HHS, because I've dealt with them and I've done over 100 of these NICRAs with them, they tend to put you in a box. They'll let you have a fringe rate if you want to show one. They may not negotiate it with you, and they're going to give you one indirect rate. And in some cases it will include facility costs, in some cases it won't if it's charged direct, and then your admin costs. So that's just a way, just to give you an idea, that's the way HHS works and so forth in their mind. They do talk about prior written approvals, and they use as an example pre-award costs or something else. That's to get something up front that you know is unique. I'm telling you that the grants officers are few and far between, as you probably know in conversing with them, that it's not so easy. So you want to put things like, you want to be forward thinking, and you want to put things in your grant application budget that covers unique cost issues, and put a narrative, and then say on the top of it, if you accept our proposal, our dollar amounts, you accept what's in our narrative. So you kind of cover yourself and say, you accepted this, baby. So, this is what we said it would be. You can't argue about it later, although the government could, but it's better to do it this way than try to do some kind of advanced agreement or prior written understanding. Now, someone very, very well and very smart this prior week was talking with us and said, our grants always don't, our grant year and our fiscal year are two different things. So let's say you have a 12/31 year end. You start 1/1 each year, you end 12/31 if that were the case. And your grant starts October 1st. Then your grant is going to actually be in two fiscal periods. Indirect rates are developed not by grant year, but by fiscal year. So if your grant year and your fiscal year are not the same, you're going to have, it's going to cover two rate periods for just a one-year grant. So be aware of that process, because the government's saying your cost accounting period, the period for allocating cost, has to be your fiscal year. You would think it'd be your grant year, and you say, why not? Because many people have different grant years, and then it would become totally confusing. The fiscal year generally does not change, and that's why it's a much more reliable way to do that. Generally, where most of your money is, that's the cognizant agency. Unfortunately, in your situation, or fortunately, HHS is your cognizant agency by regulation, by statute. HHS, if you don't know, they're a very smart group. There are 5 regions in the country, and they have the most qualified, talented people of all the agencies. But sometimes a negotiator, that's what they call the rate people that review your rates, you know, they think they know the rules. And we've shown them a few times that they didn't. So if you have a disagreement with them and you know what the rules are, show them the rules. Don't just back off and say, well, the government knows what's best for me. No, the government does not know what's best for you. You know what's best for you. So you have to stand up. You don't need to be disrespectful, and just share with them these kinds of situations if you have a disagreement. But some people just roll right over and say, well, it's the government and they know what's right. If you feel something's wrong, then let's talk about it. If you had a new award and it was the very first time, they give you 90 days to submit it. You're not in that situation. Some people have program restrictions. You may or may not in your direct awards. You may have caps, or your state governments may have put caps on it. Issues where the agency is not proactive in settling negotiating rates, that won't apply to you, because HHS, they're very, very clear on a lot of these things. There's no mystery with them. Okay. Generally with indirect rates, and this is something you should know, they give you 6 months after the fiscal year end to submit your next year's rates if you're not going to have it automatically extended. So you have 6 months that gives you time to do your audit. You could have your financial statement audit done if your A133 is not done, but HHS likes to see both. So, you know, the ideal is 6 months. If you're going beyond it and you're like just a couple of million in operations, you can notify them that you need an extension, but they're not going to come after you. If you're like AARP, not that they are with HHS, but if they were, you know, they're over $1 billion entity, they're going to be on AARP's case as an example, as a make-believe case, to get their thing in within 6 months. Now, the cognizant agency always has the option of deciding how often you need a negotiated indirect rate. They may say, here's your provisional rate, we'll see you in 2 or 3 years. So now if you feel the next year your rate has changed quite a bit, you have the option to go back and talk to them. But just read your NICRA, that's a negotiated indirect cost rate agreement, read that and see what it says. And unfortunately, NICRA is an unofficial term that everybody uses, but there hasn't been anything to basically in the new rules that officiate it, but that's what the short terminology is. Now, there are many different types of negotiated rate. One is called a predetermined rate. Basically, it's an estimate of cost to be used in the current or future periods. With our situation with a particular entity, they may have a final rate that we're trying to submit to them, which I'll explain in a minute. But in reality, there's some parts of their allocations that they've done for the first time, and there's some estimates, and we may refer to that as a predetermined rate simply because the internal allocations are based on some kinds of estimates for the first time, which many of you may have to do in order to get a sense of your indirect cost. A fixed rate is a very unusual rate. You probably won't see it, but it's the difference between the estimated and final cost in a particular year, and then they're carried forward into a future year. NOAA likes to use this. I've seen it with NOAA, and it's misery because you're always, it's like a dog trying to catch its tail. You never catch up because the difference is thrown into a different year, whether it's a plus or a minus. The final rate is the most common, and that's probably what HHS will negotiate with you. When your year is finished, you'll base it on historical costs. Once it's developed, it can't be adjusted. And in the interim, often what HHS and most agencies do is your final rate, let's say it's a 12/31/15 and say it's 15%. That will be your final rate for that year, and they'll use that as the provisional rate of 15% for upcoming year or years, depending upon how they want to do that. And provisional is used in the interim for funding, interim billing, cost reporting, the things that you need, because you got to make decisions about your indirect, and so they give you something which will later, provisional will later be readjusted to a final rate. So you could actually make a little bit of money, get a little bit of extra cash, but then you'd have to give it back. Or if it's less, I mean, if the rate is actually more, than your provisional rate, you probably won't get that difference, because if it's not in your grant, and that's where the funding part is, and that's why this is such a involved process, because you have to manage your budget and see what was set aside for indirect. And sometimes, again, program takes more, and you may be left with less money, and the government's not going to give you more money. All of you know that. Once they give you a budget, that's pretty much it. And if you're going to get additional funds, it probably won't be for indirect. So that's the sad story. That's why you got to monitor your indirect rates during the year. And they did talk about negotiating rates being accepted by all federal agencies. So they're supposed to do that. Whether they do it or not, that's another story. But anyway, we'll go through that. Let's go through some of the cost allocation methodologies as we are about 20 minutes away from finishing. The simplified allocation method is the method most people use. And it basically is, you divide your indirect rates by your direct allocation base, which we'll talk about in a minute. And often in this case, facility costs for both direct and indirect is included in what we call the F&A rate, facility and administrative rate. Sometimes the direct facility costs, because you guys are ILCs and you have infrastructure, they may be funded direct, and so it's a different process, and we'll talk about that real quickly. Okay. They talk about constructing an F&A rate, and it's very important to understand facilities and equipment and capital investments, all that good stuff. That's your occupancy. That's one part of your F&A rate, your facility administrative. But it also includes an allocable share of fringe benefits if there's labor in there, if there's somebody operating, a facility manager or something like that. On the other side, the administrative part, which is your executive group, your finance, it could be HR, IT, depending upon how you're set up, and other people that are indirect. Could be a center coordinators, charging sometimes indirect. It includes the cost plus their allocable fringe benefits and their occupancy costs, because they got to sit somewhere. So that's just something to think about. They also say that if you were, and some of you wished you may have this amount of money, if you have more than $10 million in federal funding, then in direct costs, then they do want you to separate your occupancy from your facility cost. I'm sure most of you probably are not in that situation, so that won't be an issue. But that is there nevertheless. They would want two separate rates. And then this whole slide goes through the different kinds of allocation base. The first is a long-term, but it's the largest allocation base. It's called the modified total direct cost base, and there are a few exclusions in it, but it's all your direct costs. It's your direct labor, the applied fringe on direct labor, and your other direct costs, such as contracts, except there's limitations on those, equipment, travel, supplies, that kind of stuff, and other things. Could include occupancy too. HHS also implies just a direct labor base, but you can see the number is shorter, and when the number is shorter in the denominator, the rate goes up. The number in the denominator is bigger, the rate goes down. And then you can also have a salary and fringe base, but you cannot have an allocation base based on special cost studies. So just be aware of that. Time studies and things really don't fit with this world, as you'll see. And so they're saying there's a few exclusions from the modified total direct cost base. And the first one is subcontracts and subawards. If you were to have them, you only get the first $25,000. And then I will explain later that it won't, all it does is impact your rate. You'll still get what you're determined to get, and I'll show you that in a different example later, so please don't panic on that. But that pulls out, if you have a lot of occupancy or rent costs, that would come out, capital expenditures, something called participant support costs where you train people in a certain area, or research patient care charges. So there are some things that they wish for you to remove from the base. This is the part that some of you have to understand, that if you have fundraising, if you have lobbying, if you have some kinds of general promotion that's not in an award or public relations, except for like a press announcement or something like a press release, those types of costs, the government says, are direct functional costs. They're not indirect costs, and they bear their share of indirect rate. So what I'm saying is they're telling you, you got to move that. They can't be indirect into your indirect. It's got to be a direct kind of area to cover those costs, and they receive indirect. So what I'm saying is these are things that have to be covered by your unrestricted or your reserves, for those of you who understand. Proposal costs are allowable. So even if you had a private foundation, if there was a private group like the Gates Foundation or Kellogg Foundation that were to fund something and you're doing really support work related to what you're doing or some research or something else, those agreements are also considered proposal costs and can be charged indirect, whether you succeed in winning those proposals or not. So that's just a nice thing to be aware of. The direct allocation method. There are a lot of organizations that are structured in a certain way where pretty much they have fundraising, general administrative, and indirect functions. And a lot of groups are like that. However, they allocate their costs like the simplified method. They just put everything into management in general or G&A or F&A. There are a lot of different terms, but into your indirect rate, and they allocate it over a base. And what the direct allocation method is saying, you can take some of those like occupancy costs and you can allocate them both direct and indirect. The reason why this becomes a little bit of a problem, as we'll talk about later, is if your grant doesn't support the occupancy cost, then there are a lot of programs that don't have any recovery of their facility costs, and a lot of simple organizations or small organizations use the simplified method where all the facility comes from their application of their indirect costs, except some of your organizations, there's a lot to say here, you have core funding, then that's a different scenario and it may come direct. So I know I'm saying a lot of things fast, but I'm trying to get through the body of material. There are three ways to allocate costs. If it's identified to a direct grant, then you allocate it direct to that grant. If it benefits both federal and non-federal work and can be allocated both direct and indirect, that's another way. And of course, you may just have items that are just indirect. You got an executive director or executive management team. You got board costs because they meet and they have meals and whatever. That just is indirect. It's just that's where it goes. Okay. So let's use an example of rent as an allocation in this example. You may have something, many of you have heard of this group, Meals on Wheels. Even when I was a young guy, I used to help in D.C. and try to help deliver Meals on Wheels to people. And everybody knows what it is. People can't get out of their home and they need help for this kind of worthy program. If it was in a federal program, we could say that rent for the storage of the food stuff would be charged direct because the rent is a storage place. It's totally identified with this one program, and you can have direct rent. And of course, some of you with core funding have direct rent. I'm going to talk about the second situation in a minute. And the third, of course, there's got to be a rent that's apportioned for indirect personnel. They're not going to sit out on the street. Your executive director, all your people are going to have rent, even though they're in the administrative infrastructure. But the government does allow you to allocate rent both direct and indirect on a causal beneficial relationship. And what they mean by that is like this. Say on the Meals on Wheels in A, we have a room, and it may be too small, but let's just say it's 1,000 square feet, and the total square footage of that thing is 10,000. Space is provided and devoted to a grant. And then what you could say is, well, this room takes 1,000 of 10,000 or 10% square footage, So we're going to allocate 10% of the $5,000 monthly rent at $500 to this area. Another way to look at it is you could do it on timesheets and say, look, we can't put a measuring tape around things. We're too small. We wear too many hats and that kind of thing. So what we're going to do is base it on timesheet. And based on timesheets, we allocate this cost. It was $20,000 in a month, over $80,000 for total payroll, and we had a percentage of 25%. Then 25% towards $5,000 could be $1,250. These are two different methodologies. You have to be consistent, and therefore depreciation, rental costs, you kind of group them together, and you can allocate them out in a way that works. Often people do it on FTEs. They do it on hours. They do it on direct labor dollars. I would recommend direct labor dollars because they come from financial reports and they're easier to deal with. Okay. The only other thing I wanted to say that's most important in here is that the direct allocation method is often used where you don't have a negotiated rate because it's giving you some occupancy costs that you're going to put on a federal ward. But once you have a negotiated rate, normally people want their indirect infrastructure to be covered through the facility and administrative rate, their indirect rate. And the reason is because you can't have direct purpose rent charged direct and have it indirect. It's got to be one or the other. You can't have inconsistencies or it causes problems. There is a multiple allocation method. We're not going to go over that, but it's basically when you start to have a fringe rate, an occupancy rate, and an administrative rate, there are different ways to allocate it. There's a certain order to allocate them, and we're just not going to deal with that today. The last thing I wanted to end with, which I think ends our discussion today, is a brief discussion on time reporting because many of you are going to deal with, if you're going to go to a negotiated indirect rate and get off a cost allocation plan, how do you do your time reporting? Has it been based on some kind of cost or time study or something else? And so if you're going to go off that kind of thing and onto a time study, here are two forms. And they're very small, they're hard to see, and you'll have to, blow them up later. But one on the left is like a work authorization form. What if, like in one of the groups we're doing, what if they have many, many, many charge codes, and people can forget the charge codes that they have? They may feel there's not an integrity there. It's like a boss is telling me to charge this, but I really don't know if that is for that grant. And so sometimes what they do is they put an internal control in there, and they say for the next year, we're going to give you 4 of these, and these are your charge numbers, and these are the things that relate to the grants. So that no one can play games with the time management system and try to move costs around to try to get an unfair advantage and recover costs that they shouldn't recover. And so this is like a control. The other form, which is hard to read, it just basically says, I agree that I have read, I understand, and I'm going to abide by the timekeeping policy. And it never protects management, but some people, they start moving charges around that they shouldn't do, and the whole group gets in trouble. This is a standard timesheet. This is for a week, but normally it would be for a biweekly or semi-monthly or whatever mechanism you have. But you notice in here, this is an internal control. The employee signs, the supervisor signs. There are dates in the week, so everyone knows what those dates are. The direct effort is here. The indirect administrative efforts down here going across, and even paid, whatever your paid time off situation, whether you have PTO, whether you have vacations, holiday and sick separated, whatever method you have. This is what sometimes timesheets look like. Yours does not have to look exactly like it, and the government, which is really nice under the uniform guidance, supports the whole concept of electronic time reporting system. So to finish with the last few slides, these are the new regs for uniform guidance. And basically what they're saying is that your accounting system, your time reporting system, has to be based on the system of internal controls. That is, forms and other things that get you to charge the numbers the correct way, and that they're allocated and properly, because that's the big deal with the government. It's a part of your official records. It represents a whole 100% of your total time. And you're not discriminating between federal and non-federal activities. You're charging both, so they can see how the charges are going forward. And it can be a part of your subsidiary records. The key here is that how do you know you must put time on a timesheet? Pretty much, if you're charging a federal award, even though it doesn't say it here, usually you're not working on just one federal award. Most people are working on one or more federal awards. And so they want to see the distribution of time, or a federal award, a non-federal award, an indirect and a direct cost activity, or multiple indirect activities that are allocated over different allocation bases. That would be for a university where it's really, really large. And then the last one is hard for people to get their hands around, and that is executive directors do many different things and wear many different hats. So they may charge direct sometimes. They may charge indirect, but they may swerve into fundraising because they're a rainmaker. They may do lobbying. They may do public relations. And these are different kinds of charges that your system should set up. Some audit firms, if you have an A133 or the new single audit, it's the same thing, may test for that. Others may not, but it's still a requirement. No more documentation is required than that, except if you have non-exempt people. They want you to track your hours, per day. You cannot estimate labor before it's incurred. If you have a cost share match, many of you may not, but if you do, you have to use the same record-keeping requirements. And if you had an alternate process or policy and said, I can't do it on one of the systems you've set up, you've got to get it approved, and the people that approve it will be people like HHS Cost Allocation Services. So if you have an alternate time reporting system that's based on performance-oriented metrics, that has to be approved by the same people that approves your indirect rate. We're almost done here, and we will try to finish on the hour. Go to the next one. People ask the question, what do we do if we have multiple funded wards where effectively we have the same scope? And the government really didn't help you on this. We were hoping that it would be just a simple, well, you're funded so much, and just, based on the funding levels, allocate the cost. But they don't say it that way. They make it very complicated. And they say that it gets allocated on performance-oriented metrics, which, again, you'll need your program people to divvy up. So if you're in that situation, that's how you do it. The last statement basically says that if you can't meet the standards that I showed you on 59 and 60, then you should have a regular timesheet. What they're saying is, they're not saying don't have a timesheet. The government is saying you may have an electronic system, and as long as you have these things in that electronic system, you're free to do what works for you. This is the last slide, and this is something that I wanted to share with you, and that is very clear that some of you may be on time studies. The government never really gave you permission to do that. But sometimes what happens is you may have been an extension of what they thought was a state government, and state governments are allowed to do time studies, but local ILCs that are nonprofits technically are not supposed to do time studies. It's supposed to be on an actual basis. It's not supposed to be on percentage of time. I didn't go over that, but in the rules, it's only for institutes of higher education for specific purposes. So these are things you need to take into consideration. I don't want to alarm you, but it's just things to think about as you move on to HHS. You should move on to an actual time reporting system, semi-monthly, bi-weekly, that kind of thing, hours times rate, that kind of way of doing it, and that will help you in developing your indirect rate. So I do have a few minutes if people have some questions. There's a lot of information here to digest, and I realize also my speed, but I wanted to try to cover these things. It's fine for you to take time and digest it. And also you may have someone internal that's going to help you, or a consultant, CPA firm, whatever, and it will take time to digest this process as we go forward. The goal in the second session, which will come back in an hour, is basically to try to talk about what kinds of information will you gather in putting together an indirect rate, and we'll show you some examples, and hopefully that will begin to develop and help you with this transition process.